Hello everybody, welcome to this video on a decision tree methodology and how you can use it in the context of global supply chains. This is chapter 6 from the book. So let's begin. Now, globalization has had a huge impact on supply chain industry. I mean, this is something you could have said even 20 years ago, but it's a huge deal. Now, what we will be doing in this, as part of this course from this chapter is we'll be looking at how you can use decision tree methodology to evaluate decisions that have multiple options. So this is one way to do it. The other way to do it, the other example that we saw was linear programming. Now this is an example where things might not be linear. They could be variable, but let's see how that goes. Now, before we actually get into the decision tree methodology, we have to talk about discounted cash flows, because many decisions that we'll be talking about will be decisions that will be made over a long period of time. It could be a year, 2 years, 3 years, maybe even longer. So when that's the case and you're making a decision right now and you're evaluating decisions based upon money that you're either making or spending 2 years down the line, you need to discount the cash flow properly, because $1 today is worth more than $1 next year, and usually that is represented by a rate of interest and depreciation and inflation. There's so many other things that go into it, but having a dollar right now is worth more than having a dollar 1 year in the future. Okay, that is that's the idea of discounted cash flows. Now again, this is something that you must have probably seen in all your many of your accounting classes and maybe in other classes too. So let's quickly go through this, look at a simple example, and then we will supersize that example and see what happens when you have multiple options to take care of. So let's begin with the idea of discounted cash flows. So whenever you have monies that you are either going to spend or make in the future, and you want to find out what the value of that money is right now, you calculate something called NPV, or net present value. NPV, or net present value. That's the net present value of this money stream that you have, and it is calculated based upon the discount factor. Now, usually these discount factors are annual discount factors. That is, you're looking at money today versus money one year in the future versus money one year in the future after that, and so on. So the time period that you see here, the T that you see here, is usually years, but it could also be any time period. It could be weeks, it could be months, it could be I don't know, quarters, it could be any time period that you think of, but then you have to make sure that you're discounting properly. So C0, C1, CT are as a stream of cash flows over capital T time periods, and you're calculating the net present value by adding C0. So C0 is cost that you're incurring right now. C1 is cost you're incurring one period in the future. So that is discounted by C1 times 1 over 1 plus K. So you're discounting it by 1 over 1 plus K. So let's say that K is, say, typically is say 10%. So if you have $100 right now, it's worth $100. If you're going to get $100 1 year in the future, it is worth 100 times 1 divided by 1 plus 10%. So it will be 100 divided by 1.1, which will be $90.91 approximately. So if you are going to get $100 1 year in the future, and you're calculating net present value based upon a discount factor of 10%, you're saying that future money is worth approximately 10% less. You are going to, the $100 that you're going to get in the future is actually worth only about $90 and, what was it? $90.91 right now. And that's how you calculate it. If you're looking at 2 years in the future, it will be 1 over 1 plus K times 1 over 1 plus K times 100. So it's 1 over 1 plus K squared times 100. So if it's 2 years in the future, it will be 1 over 1 plus K. So it will be divided by 1.1 times 1.1. So $100 2 years in the future will be worth $82.64. If you're going to get $100 2 years in the future, right now the net present value based upon a 10% interest rate is $82.64. And that's the idea of net present value. Again, you're all very, I'm sure you've all seen this in many contexts. So let's take a simple example. This is an example where you're evaluating options for renting a warehouse space, right? It's a very common thing that you come across in supply chain problems and logistics problems. So here is an example. You have demand for 100,000 units and you need 1,000 square foot of space for every 1,000 units of demand, which means approximately every unit of demand you need 1 square foot of space. Now this is not always the case. You might have different square footage requirements and whatnot, but in this problem that is the case. Now the revenue is $1.22 per unit of demand. That is, every time you sell this item, this widget or whatever you're selling, you're going to get you're going to make $1.22. So we have two options here, and we're going to evaluate these two options. The first option is, should we sign a 3-year lease where we fix the price, but then we have to pay, we might have to pay certain premiums, or obtain warehouse space on the spot market. If you sign a 3-year lease, you are going to get it for $1 per square foot. So every square foot that you rent, you're going to pay $1 per square foot. And on the spot market, you are only going to pay $1.20. You're going to pay $1.20. It's more. So what is the spot market? Spot market is you figure out what your demand is. Let's say you have demand for 80,000 units. Then you go to a person who rents out warehouse space and say, hey, I need 80,000 square foot of space. And you are renting that space on a as needed basis. So when you rent space on as needed basis, it always costs more. This is similar to, let's say you're renting a house. If you sign a 1-year lease, you usually pay a certain rent. But if you want month to month, you're likely going to have to pay more because the landlord doesn't have a steady stream of income. So it's the same idea here. We're also going to take 10%. Now 10% is probably going to be standard, but don't always consider it. But mostly we'll be using 10%. So let's evaluate these two options, right? Let's first evaluate the spot market option, and then we will evaluate the 3-year lease option, right? Okay, so if you're just buying everything in spot market, now we know that our demand is 100,000 units, so that's a fixed amount of demand, exactly 100,000 units. So what is the annual profit that you make per year? So 100,000 units, you're selling it at $1.22. The warehouse space, if it obtained, is 100,000. So the cost is 100,000 times $1.20, because that's what you're paying for the spot market price. So you'll make about $2,000 per annum. That's how much money you're going to make per annum. And so because you're going to make, so we are looking at this over 3 years, it's 2,000 right now, plus 2,000 1 year in the future, plus 2,000 2 years into the future. And if you add this all up, the value of this is 5,471. That's the expected profit that you can make, expected net present value of the profit based upon buying everything on the spot market, right? Obviously, you can see that if you buy everything, if you sign a 3-year lease, this is obviously cheaper. Your demand is 100,000, your revenue is $1.22, and this time you're only paying $1 per unit, so it's 100,000 times $1. So this is where you're signing a 3-year lease. So you'll make $22,000 per annum. So it'll be $22,000 right now, plus $22,000 1 year in the future, divided by 1 plus K. So K is 0.1, so 1 plus K is 1.1, and then 22,000 2 years into the future. And so the net present value of all of this put together is $60,182. That's how much money you're going to make by signing a fixed 3-year lease. Now, this is a slightly artificial example for a couple of reasons. First of all, spot market prices keep changing all the time. So spot market prices that you have right now might not be the spot market price in the future. So that's one thing to keep in mind. The other thing is demand. We are assuming that there is a fixed demand of 100,000 this year, a fixed demand of 100,000 next year, and a fixed demand of 100,000 the year after that. And in many real life cases, demands are not fixed. Now, this is not completely unrealistic. Let's say that you have a contract with a customer who wants you to sell them 100,000 units, and you are renting this warehouse space specifically for them. And in that case, you can be sure that 100,000 units is your demand exactly, and you can go ahead with that, assuming that you know that the client is not going to renege on the contract, or they're going to go out of business or run out of money or something. If you are sure about that, then you can be sure that demand will be 100,000 for the next 3 years. But that's not always the case, right? So based upon this only, the net present value of signing the lease is 60,000. The net present value of not signing the lease is 5,471. So this is how much you'll be making more if you don't sign the lease. If you sign the lease, so 54,711, that's the extra profit that you're going to make. So it makes sense for you to sign the lease based upon this, right? So this is a simple explanation of how net present value works, right? Okay, proceeding. So let's continue with this TRIPS logistic problem and talk about what I said before. What if demand is variable? What if spot market prices are variable? How do you manage that? How do you understand that? So for that, we will use a technology. We'll use the idea of decision trees. Now, decision tree is an overarching term for many different types of methodologies that are used in different scenarios. So you might have heard of decision trees in the context of, say, data mining. So the decision trees that you build for data mining, they are different. The decision trees that you might have learned, let's say in the operations management class, or even if you've done the spreadsheet modeling class, you might have heard of decision trees there. That is again different. In all of those scenarios, you're making decisions, then you're facing states of nature, you're making multiple stages of decisions. Here you're making a single decision. So this is in a way a slightly simplified version of the decision trees that you might have learned in the spreadsheet modeling class, but it is also more complex because we'll be looking at way more options for that single decision. So it's different. So decision trees is like I said, it's sort of a name that is used for different sorts of methodologies. The thing that is common is that you sort of build something like a tree. So you start with a single something on the top, and then it sort of grows. So it sort of looks like a Christmas tree if you put it up on its side. So these are all decision trees. So right. So there are many different decisions to make. So one is, should the firm sign a long-term contract, or should the firm mix long-term and spot market? What capacity should they have, and all of that. So there are many questions that need to be answered. So let's see how these questions are answered. Okay, so decision tree is a graphic device used to evaluate decisions. So to do this, we need to identify the number and duration of time periods that will be considered. This is important. Are we just planning for 2 years? Are we planning for 3 years? Or are we just planning for even a year? If you're just planning for 1 year, there really isn't a tree that you're building. But if you're planning for 2 or more years, you have to build a tree. That's what we'll be doing. Okay, so what we will do specifically in this context is identify the number of periods over which decision needs to be evaluated. Identify the factors whose fluctuation will be considered. And this is important. In many real life problems, there are lots of things that keep changing. But for you to evaluate these options, the more things that change, the more uncertainty in your problem, the more complex your problem becomes. So what we will do is we look at a simple case where there are one or two levels of uncertainty, and then see how you evaluate a decision tree. Now we will not be looking at more complex or more complicated sort of uncertainty. We'll just look at a brief introduction to how uncertainty works. Let me put it that way. Now we'll represent the decision tree with defined states. So decision tree has something called states. This is like leaves on a tree, in which in each period, as well as transition probabilities between the states in successive periods. Now, one thing that's common with most decision trees methodologies is you always start at the end of the tree and you work your way back. That's usually how it works. So what we'll do is we'll go back to the same TRIPS logistics example that we had, and we will evaluate 3 different options. Now we'll be doing this over 3 years, so it might look like it's going to get complicated, but it really isn't. It's just a matter of calculating profit values under different scenarios. You need to know what the demand is, you need to know what the spot market price is, and then calculate profit. The calculation itself is pretty straightforward. The thing where you might get tripped up is figuring out what all the possibilities are. That is the crucial piece here, and you will see that. So these are the three options that we're considering. The first one is we get all the warehousing space from the spot market as needed. It's a similar idea as what we had before. The only difference now is that before we had demand was exactly 100,000, spot market price was exactly $1.20, and that's what you had for all 3 years. That won't be the case anymore. So sometimes it is possible that spot market price might go below your contract price. So contract price in the previous example was, if you signed a 3-year lease, you'd be paying $1 per square foot. But what if spot market price went below $1 a square foot? Then you're better off buying it off the spot market, right? So that's why buying everything off the spot market might be useful. But that's one of the options that we're considering. The second is you sign a 3-year fixed lease. So you sign a 3-year lease for a fixed amount of warehouse space and get any additional requirements from the spot market. So like again, you're saying that we are looking at cases where we will be looking at, in this case, where demand is a variable. So if demand is variable and you start by saying, okay, I start off with a demand of 100,000 units of demand, which means that I need 100,000 square feet of warehouse space. That's how much I need to rent. So if I sign a 3-year lease for 100,000, it might be that second year, 1 year down the line, demand is more than 100,000. If demand is less than 100,000, you still have enough warehouse space. You'll just have some space in the warehouse empty. But if demand is more than 100,000, you still need more warehouse space. In which case, you'll have to buy it on the spot market from somebody else using the spot market prices, right? Now, the third option is we'll do something similar to option 2, where instead of signing a fixed lease, we will sign something called a variable lease with a minimum charge, and we'll have some additional requirements. So these are the three options that we will evaluate. In the third option, you're saying that you will pay, say, $10,000 upfront. You will pay $10,000 upfront and say that I want warehouse space that is not exactly 100,000 units. In the fixed lease case, we will always rent 100,000 units for all 3 years. In the variable lease case, we'll say that I will rent anywhere between 60,000 and 100,000 units, right? I'll rent anywhere between 60 and 100,000 units, and for this extra flexibility, I would like you to, you will pay $10,000. So the renter is saying, I will give you that flexibility, but because I'm not sure that you'll be renting all 100,000 square feet of space, you have to pay me an extra $10,000. So there's always a catch. There's never a free lunch, right? So let's evaluate these options, right? So let's go ahead. The very first thing that you always do with decision trees is build a decision tree. Before that, here is the data that we are going to be using. It's the same as before. We start off with a demand of 100,000 units, and we know that we need 1,000 square feet of space for every 1,000 units of demand. The current demand is 100,000. Now, all points of uncertainty, we will assume are binomial uncertainty. This is the simplest form of uncertainty that you have, where things either go up or go down. They don't stay the same, they just go up or go down. So you're saying that demand right now is 100,000 units. You're saying that demand can go up by 20% with a probability of 50%, or go down by 20% with a probability of 50%. So what you're saying is that if demand right now is 100,000 units, and it is 100,000 units, next year demand can go up by 20%. So next year demand can be 120,000 units with a 50% probability, or it can go down by 20,000, which is 80,000 units with a 50% probability. So this year demand is 100,000. Next year demand is either 120 or 80. It's 120 with a 50% probability, and it's 80 with 50% probability, right? So that's something to keep in mind. So that's how demand is variable. Now, lease price is $1 per square foot. So if you buy anything per lease, you just pay $1 per square foot. But the spot market price for the first year is $1.20. But spot market prices can also change, and this change will also be a binomial change. So you're saying that spot market prices can go up by 10% or go down by 10% with a 50-50 probability. So what does that mean? Right now, the spot market price is $1.20 this year. Next year, spot market price can be 10% more, which is $1.32. So 10% is 12 cents. So it can be 10% more. So you might be paying more for spot market. There's a 50% chance that you'll be paying $1.32. And there is a 50% chance that you'll be paying 10% less, which is $1.08. So you might be paying $1.08 1 year down the line, or you could be paying $1.32. Now, we are planning not just for the current year and 1 year in the future, we're also planning for the year after that. So what does that mean? So if spot market price went down, let's say that we started $1.20, next year it became $1.08, and the year after that, again, it went down by another 10%. So 10% of $1.08, that'll be reduction of about 11 cents. So the price went down to 97 cents, right? So your spot market price 2 years down the line might be less than your lease price. So that is why we are keeping this option open, that we can buy space from spot market. Otherwise, if the spot market price is always going to be higher than the lease price, you don't even consider the spot market option, right? Getting everything on the spot market option, because you will need something from the spot market most of the time. Okay. The revenue is the same, $1.22, and we are discounting future monies at a rate of 10%. So, like I said, step one is to build the decision tree. Now, this decision tree might look big, but it's really not that difficult. So right now, so the way you build a decision tree is you draw an oval or a circle, and you call these nodes. You have nodes, and each of these nodes represent a possibility. So right now there is only one in period 0. So you'll notice that there are 3 periods: period 0, period 1, and period 2. This is right now. You always represent the current time as period 0, period 1, and period 2. So you're planning for 3 years. The current period, the next period, and the period after that. So right now, next year, and the year after that. Okay? So you're saying that right now demand is 100,000 units. So all of these demands are thousands of units, but demand is 100,000 units, and the spot market price is $1.20. Now, this is right now. What are the potential possibilities a year in the future? So remember, in the future, demand can go up or demand can go down. Spot market price can go up and spot market price can go down. And these things are independent of each other. Demand can go up and spot market price can also go up. Or demand can go up and spot market price goes down. So we have to enumerate all the possibilities. So there are 2 things that can happen. So demand can go up and spot market and demand can go up or down. Spot market price can go up or down. So there are in total 2 times 2, 4 possibilities, right? So demand goes up, spot market price goes up. So remember, whenever demand goes up, it goes up by 20%. We are assuming binomial uncertainty. So demand will go up by 20% or go down by 20%. And with a 50-50% probability. So what is the probability that demand will go up and spot market price will also go up? Both of these things happening. So there is a 50% chance that demand will go up. There is a 50% chance that spot market price will go up. So there is a 50 times 50, a 25% chance that both demand and spot market price will go up, right? So this 25% that you see here, the 0.25, comes from the 50% times 50%. 50% chance that demand goes up, 50% chance that demand goes down, right? And that's that. Similarly, demand can go up, but a spot market price can go down, or demand can go down and spot market price goes up, or demand can go down and spot market price goes down. So these are the 4 possibilities, 1 year in the future. Now 2 years in the future. So there were 4 possibilities from here. 2 years in the future, there should be 16 possibilities, and there are, but some of these numbers overlap. So what it boils down to is 9 possibilities. And this will always be true with binomial uncertainty. When you have 2 levels of binomial uncertainty, you will start with a single node for this period. You will go to 4 nodes for the period after that. And you will have 9 nodes in the period after that. It doesn't matter which sort of uncertainty you're looking at, as long as it is binomial and as long as the probabilities remain the same. The probabilities also don't matter. As long as it is a binomial uncertainty, the possibilities in the 1 year in the future and the possibilities 2 years in the future, they will remain the same. These are the possibilities, but we need to know what the probabilities are for those possibilities, and they are different. So there is only a 25% chance that this will happen 1 year in the future, and there is a further 25% chance that this will happen 2 years in the future. So what is the probability that this particular thing will happen? The probability that this particular thing, that demand is 144,000 and spot market price is $1.45, is 0.25 times 0.25, which is about 6.25%. Really small possibility, right? It's the same for all of these. Now, some of these have 2 arrows coming in, so the probability is double. This has 4 arrows coming in, so the probability is 4 times. So there's almost 25% here. There's 25% possibility here. There is a 12.5 probability here, 12.5, but otherwise the rest are all 6.5. But that doesn't matter. We are not going to multiply probabilities across years or anything like that. The important thing here, when you build this decision tree, and I suggest that for every decision tree problem, you build this decision tree, is you just have to evaluate the possibilities. And as far as this course is concerned, because we are only going to be looking at binomial uncertainty, you will start with 1 node, then you will go to 4 nodes, then you will go to 9 nodes. That's always going to happen. That's exactly how it's going to happen too. Okay, just keep that in mind. So these are all the possible combination of demand and spot market price for 1 year in the future and 2 years in the future. So using this, let us evaluate the net present value of these 3 lease options, right? So how would I calculate that? How would I calculate the net present value? Well, this is how you do it. So first, you begin by calculating, so you always begin at the end of the decision tree and you work yourself way back. Always. That's how it always works. The first thing that you're going to do is, if this is a scenario, if demand is 144,000 and the spot market price is $1.45, what is the total profit we expect to make for this particular scenario? We're going to calculate that. We'll calculate this profit for this scenario, then the profit for this scenario. We'll calculate the profit for all of these 9 scenarios. And then we're going to calculate the net profit for this scenario. So when we calculate the net profit for this scenario, we are going to calculate the profit if demand is 120 and spot market price is $1.32, plus this there's a 25% chance that this is going to happen in the future. Plus there's a 25% chance that this is going to happen in the future. There's a 25% chance that this is going to happen in the future, and another 25% chance that this is going to happen in the future. So when we calculate the net present value of the profit here, we are not only going to calculate the profit here, we're also going to include profit from all future possibilities that come out of this particular possibility. So this is not probable after once you go to this possibility. This is only probable if this happens in year 1. And again, this is only probable if this happens in year 1. So when I am evaluating the net present value here, I only have to look at the 4 possibilities that emanate out of this particular possibility. So I calculate the net present value here, net present value here, net present value here, and net present value here. And then after I do that, I do a similar thing here. I calculate the net present value here. I calculate the profit here, and then 25% chance of this net present value, 25% chance of this, and so on. And then I'm going to add all of that up, and I'm going to get a single value telling me that this is how much money we are going to make if we pick this particular decision. That is, do everything on the spot market. We'll begin with that. And then we look at the fixed lease option, and then we look at the variable lease option, right? Now, the calculations are all given here. I am not going to go through these PowerPoint slides. Instead, what I'm going to do is I'm going to show you how we can do these calculations in Excel. So it sort of automates a few of these things, because we're always calculating the profit in very similar ways. So we'll just try to automate everything, right? So that way, instead of doing like 9 plus 4 plus 9 plus 5, 14 calculations by hand, we'll just do one of them, type of formulas for one of them, and just copy and paste the remaining formulas. So let's see how this works. I have this here. Let me let's begin from the top. So I'm going to begin with spot market only. So as you see, I'm going to call it spot market only, or let me just call it option 1. You guys know what options are, what the options are. I'm just going to call it option 1. So in option 1, you're buying everything from spot market only. So because you're buying everything from spot market, you need to keep track of the spot market price. It's very important. So the same goes with demand. So you have period 0, right? Then you have period 1 and period 2. So for each of these periods, we're going to calculate the following. So we're going to calculate what the demand is. So we need to know what the demand is. We need to know what the spot market price is. I'm just going to call it SMP. SMP short for spot market price. So we need to know what the demand is. We need to know what the spot market price is. Then we need to know the cost, the total cost, and then the revenue and profit. And then we have net present value profit. Now, what does this mean? So net present value of profit. So you calculate something for period 0. When you calculate net present value of profit for period 0, you're not only calculating profit just in period 0, just like we talked before. We're not calculating profit just for period 0, but we're also going to include profits of everything that's going to happen in the future. So that's net present value of profit. Where's my other one? I just like to get the headings. Okay. Right. Let me do this. Okay. Let me make this bigger. Okay. So for period 0, we'll have, so demand is 100,000, right? Demand is 100,000 and spot market price is $1.20. So we have that. Let me see, does this work? Yeah, it does work. Good. Spot market price is $1.20. For period 0, so we always begin with writing down all the uncertainty possibilities. So we are basically building the decision tree. So this decision tree that you have here, we're going to build this decision tree, but we're going to write it in Excel. So in Excel, because you can't build a tree like this, I'm going to make rows for each of these. So one period into the future, what are the possibilities? So remember that demand can go up or down by 20% with 50-50 probability. And a spot market price can go up or down with 50-50 probability. So you know what? I am going to include... No. We'll do that later. Okay. So demand can go up 20%. So it'll be 1.2. So 20%. Demand can go up by 20%. Right? And the same goes here. So demand can go up by 20%. So why am I writing it twice? Because demand can go up by 20% and spot market price also goes up by 10%. Right? So demand goes up by 20%, spot market price goes up by 10%. Then demand goes up by 20%, spot market price goes down by 10%. Right? And similar, then demand goes down by 10%. So it'll be 90% times that. The same goes again. Then demand goes up, spot market price goes up by 10% and spot market price goes down by 10%. I just like writing this first. I don't know, it doesn't matter, right? There you go. So these are the 4 possibilities 1 year in the future. 2 years in the future, these are the 9 possibilities, right? So demand goes up. So if you notice, if you go back to the decision tree, you'll always notice that there are three possibilities of demand going up and three possibilities of prices which get cycled around. So 144, 144, 144, 96, 96, 96, and 64, 64, 64 for demand. Then 145, 119, and 97 cents for spot market price. So what I'm going to do is I'm going to write these in order. I'm going to write all the possibilities of demand going up. So there are three possibilities of demand going up, three possibilities of demand going to 144, three possibilities of demand going to 96, and three possibilities of demand being 64. So let's write those down. So it'll be 20% increase from here. So 20% increase from here, and there is a 20% increase. I'm going to use the same cell here. Now for the 96, I'm going to say there is a 20% decrease in this. There is a 20% increase from this. So that's why you'll notice that these numbers are the same, because a 20% increase from 96. Wait a sec. Yeah, I messed up. This will be 80%. I'm so sorry. Right. There's a 20% increase and a 20% decrease. 10% increase, 10% decrease. So right. So having a 20% decrease from 120,000 and having a 20% increase from 80,000 will give you the same number. So it's 0.8 here, 1.2 here. So it'll end up with the same number. That's why some of these options repeat. Right. Then of course the 64,000, that's always 80% decrease from 60,000, 80% decrease from 60,000, some 80,000, and an 80% decrease from 80,000. There you go. And then the spot market price. Spot market price is, again, goes up and down by 10%. So we'll say goes up by 10%. Goes up by 10% from here. And of course goes down by 10% from here. So this can come about in two ways. It goes up by 10% from here or goes down by 10% from here. It'll end up with the same number here. So I'm going to do this again. It'll be a 10% increase, 10% decrease, and 10% decrease from here. It's the same three numbers that are repeated. We can even type them up. If you calculate these by hand, you can just type these up too. I'm just trying to keep everything a bit kosher. Decrease and 10% decrease. So these are the 9 possibilities in period 2. So what we'll do is we'll calculate the total cost, we'll calculate the total revenue and profit and everything, and then take it from there. So total cost, so because this is the scenario where we are just using the spot market price, total cost is simple. The total cost is just demand. This is how much we need. This is how many units of square foot. This is how many square feet we need times the spot market price. That's how much it's going to cost us, right? Demand is 144,000. Spot market price is $1.45. And that's how much it's going to cost us, $209,080. So I'm going to copy that down. So that's why I'm doing it in Excel. Otherwise, I'd have to manually calculate all of these things. So these are all the cost values just by multiplying demand with the spot market price. Why? Because we are getting everything from the spot market. That was option 1. Buy everything on the spot market. The revenue is the same. Revenue is your $1.22. That's how much you're spending, times the demand, right? Whatever your demand is, you're going to make $1.22 from that. Go, copy that down, right? Profit is the difference between revenue and cost. Now, some of these will be negative, obviously, you'll lose money, and it's pretty obvious. If the spot market price is more than $1.22, you're going to lose money. Spot market price is more than $1.22, you're going to make money. So there are scenarios where you lose money, there are scenarios where you make money, but the scenarios where you lose money, you lose pretty heavily. But there are some scenarios where you make money. Now, because all probabilities were 50%, 50%, 50% in this case, there is a 25-25. So if you look at this decision tree, there's a 25% chance, 25% chance, 25% chance. So all of these numbers turn out to be 25 because in the binomial, we always assume 50-50. But that's not always the case. In fact, next week, when we look at the next example, we'll look at examples where the probabilities are not 50-50. We'll see that. And even in the synchronous session, I'll do another example and we'll see that example. I'll see if I can do probabilities that are not 50-50. Okay, going back. Right. So these are the profit values. So because we are planning up to period 2, there is no net present value from period 3 to calculate. So we are done. So let's calculate the profit for period 1. So in this case, I'm not going to write any net present values because they are the same as these numbers. So I'm just going to leave it at that. So total cost. So again, total cost is the same. You're always so this is where we have, just to give you context. So this is the scenario that we're calculating. So we're calculating the net present value of profit at this point. So when you calculate the net present value of profit at this point, it's going to be profit that you make here plus the potential profit that you can make 1 year in the future, where there's a 25, 25, 25, 25 chance of 4 different things happening, and we will include all of that. You will see that in a second. So total cost is $1.32, the spot market price times the demand. It's the same because we are buying everything from the spot market. And again, revenue is also similar. You make $1.22 and for the $120,000. Right? No, are there any? Yeah, whatever. So profit is revenue minus cost. So again, these are 2 scenarios where the spot market price is more than revenue, so you're going to lose money. 2 scenarios where spot market price is more than revenue, so you can make money. Now, this is an important piece. So when calculating the net present value of profit, right? So what I'll do is I'll split this up into two different columns. I'm going to call it net present value of future profit. Oh, you know what? Let's just write that. Let's just say net present value of profit. So when calculating the net present value of profit, you're not only going to say it is the net present value, so it's the profit that you make this period. You're also going to include profit that you make from future periods, but at a discounted rate, right? So the discount factor we are saying is 10%. So you're going to multiply everything by 1 over 1 divided by 1.1. So that's what we're going to do. So we'll do that. So we'll do that in a second. So everything. So I'm going to put a parenthesis here. Everything within this parenthesis comes from the future. So we're going to divide everything within this parenthesis by 1.1. Why 1.1? Because that's the, I'm going to put another parenthesis around it. We're doing 1.1 because that's how much we are discounting by. 10% discount, so we're going to divide it by 1.1. So this is everything that's going to happen 1 year in the future. So 1 year in the future, demand can go up, price can go up. So that's the scenario. So there's a 25% chance that this will be your net present. This will be your profit because demand will go up, price also goes up, so you'll end up making a loss. Or there's a 25% chance that demand will go up, but price will go down. So there's a 25% chance of that. There is a 25% chance of demand going down, but price going up. So demand going down, but price going up. Plus, there is a 25% chance that both demand and price go down. So demand goes down and price also goes down. And there you go. So 25% chance of this happening in the future, 25% chance of this happening in the future, 25% chance and 25% chance. So these are the 4 possibilities in the future. 25% probability for each of those possibilities. So this is the total profit that you can expect to make next year after period 1 in period 2. And you're going to divide that by 1.1 because we are assuming a discount rate of 10%. So this in total will give you the net present value of profit if demand is 120,000 and spot market price is $1.32. And that is also a loss because there are huge losses. So we're considering these two numbers and these two numbers. So there's mostly only losses here. Similarly, does this work? Can I just copy this down this way? I don't know. Let's not risk it. Okay, so similarly, we're going to have this number plus, again, I'm going to put a parenthesis. I'm going to divide that by 1.1, right? Parenthesis around it. Now, that's why I wanted to split it up into two. You can calculate everything within parentheses, the 0.25 times 0.25. You can calculate that separately and then add everything and even divide by 1.1, do all of that and just add these two numbers together. That's fine. You can split it up into as many columns as you want. Just make sure that the formula that you write is correct. That's the only thing to keep in mind. All right. So there's a 25% chance that demand goes up, but price goes up. Demand and price both go up. So in which case that's the scenario. So it's a 25% chance of this scenario, plus there's a 25% chance of this scenario, right? Demand goes up but price goes down. 25% chance of this scenario, demand goes down, price goes up, and a 25% chance of this scenario, demand goes down and price goes down. Yeah, copying down would have worked. Let me see if it works out for the others. And there you go. So this is everything that can potentially happen in the next year with the corresponding probabilities. Divide by 1.1 because it's 1 year in the future, and that's the net present value. So if this is this place where you are, you expect to make a $32,000 profit. Similarly, let me see if I can I just copy this down this way? Will this work? Let's see. So this is how much money you're going to make right now. It's a loss you make right now. Plus, let's look at the 4 future possibilities. Demand goes up, price goes up. So demand goes up, price goes up. Nope, we don't have that. So that's not going to work. So demand goes up, it'll be 96,000. Price goes up, will be $1.45. So where to begin here? Okay, so that doesn't work. I'm just going to get rid of that. Okay. First possibility, demand goes up and price goes up. So 96 and 145 plus. Next possibility, demand goes up, price goes down. Demand goes up, but price goes down from $1.32 to $1.19 plus. Demand goes down, price goes up. Demand goes down, price goes up, plus 25% possibility that demand goes down, price goes down. And that's the possibility right there. And that's a net loss again. And finally, I'm going to copy this down. And there you go. Now this will work. I think I can copy the first one down and first one. That's okay. You should just write the 4 possibilities here. 25% chance that demand goes up, price goes up. So demand goes up, price goes up from 8108 to 96119. Demand goes up, price goes down. Demand goes down, price goes up. Demand goes down, price goes down. So those are the 4 possibilities. So these are the net present values of profit for these 4 scenarios. Now let's calculate the net present value of the total profit. So for this, you will have again the spot market price times demand. This is the total cost. Revenue is again the same. So it will be $1.22 times 100,000. Profit is the difference. Net present values, again, we calculate the same way. So in this case, there are only 4 possibilities. We don't have to figure out which is which. So it'll be this plus, again, I'm going to do divided by 1.1, right? And this will just be 0.25 times this number 0.25 times this number times the third number plus 0.25 times the fourth number. Now, why am I multiplying 0.25, 0.25, 0.25, and 0.25? I hope you understand that it comes from these probabilities. There's a 50% chance that demand goes up and a 50% chance that price also goes up. So what is the probability that demand and price both go up? It's 50% times 50%, which is 25%. So that's where the 0.25 comes from. Anyway, there you go, $5,471.07. That's the net present value of buying everything on the spot market. Okay, right? Now this looked tedious, right? And it is. The reason for that is we had to set everything up here, right? Now these things will change for all the different calculations because the way you calculate cost and revenue and profit, all of that will change. But this setup doesn't change, and this setup also doesn't have to change. So sorry, the net present value setup doesn't have to change. So we will see how you can maintain that. Anyway, let me open this up. Now I know that this is a long video, but bear with me. So let's set up the next option. So I'm going to move a copy, create a copy. I'm going to call this option 2. So what's different in option 2? In option 2, we are signing a fixed 3-year contract, right? So we are signing a fixed 3-year contract, and so we need to keep track of. So we are always going to have 100,000 units of square footage available for all 3 years. We'll pay 100,000 units because we have to rent the 100,000 units. It's a fixed contract, so we're going to have that available for all 3 years. So that's not going to change. But what's going to change is the spot market price. So if demand is 144,000, demand is more than 100,000. So the extra you're going to have to buy at the spot market price. Otherwise, everything else you'll buy at 100,000. So what we need to keep track of is, I'm going to add a couple of columns. I'm going to label these columns. So contract space and spot market space. Maybe spelled incorrectly. So what does this mean? So how many units am I renting via the contract? How much square footage am I renting via the contract, and how much square footage am I buying on the spot market? That is what I'm going to keep track of, because that is what is different. So if I'm buying it contract space, the dollar is the cost is $1. Spot market is based upon the spot market price, right? So this way I don't have to change anything except for the cost. The revenues remain the same. You're still, based upon demand, you're still selling them $1.22. The profit is calculated the same way. Net present values, everything is calculated the same way. The only thing that we need to do is keep track of the contract space. So in the first year, because demand is 100,000, so if demand is more than 100,000, then the contract space will be the different, will be more than 100,000. Otherwise, the contract space is always 100,000. Even if demand is only 80,000, because you're signing a fixed lease, you still have to rent all 100,000 units of space. So for this option, the contract space will always be 100,000. Oops, this is just a number. Contract space is always 100,000. There you go. The spot market space will be different. How much space are we renting on the spot market? We only rent space on the spot market if our demand is more than 100,000. If demand is more than 100,000, you need more space on the spot market. So we calculate spot market space as the difference between demand and contract space. So if demand is more than contract space, it's the difference. So what's the problem with just calculating it this way? So first of all, this is not a number, it's just a number. Yeah, there you go. The problem with calculating it this way, oops. is that some of these numbers will be negative, obviously. If demand is less than 100,000, you're going to get negative numbers, but you don't want negative numbers. So let's change the formula. Let me get rid of everything. So we are saying that if demand is more than the contract space, then I want the difference to be how much I rent from the spot market. Otherwise, it's just zero. I'm not renting anything from spot market. So I'm saying that if demand is more than the contract space, if demand is more than let me do it the other. If demand is less than the contract space, if the demand that I have is less than 100,000 units, then I don't have to rent anything on the spot market. So if demand is less than contract 100,000 units, then I don't have to rent anything. Otherwise, I have to rent the difference between demand and contract space. Otherwise, I have to rent the difference between 144 and 100,000. So I have to rent 44,000 units on the spot market, or in this case, 20,000 units, 20,000 square feet on the spot market. So I don't have to rent anything here. I have to rent 20,000 and and I have to rent 44,000 here. There you go. So I only have to rent space on the spot market if demand is more than the contract space, right? Okay, done. Now let's calculate cost. So cost will now be the contract space times $1. It will always be $1. I mean, that's not going to change. Plus spot market space times the spot market price. How much ever you're renting on the spot market space times the price on the spot market. There you go. I'm just copy pasting the formulas. That's all I'm doing. In all of these cases, when demand is less than or equal to the 100,000 units, you will just pay 100,000 units because you signed a fixed contract, and that's the net present value. So the net present value now is $38,363.64. Again, I didn't have to go through any of these tedious calculations. Once I set them up, it's just they're all there. I just have to copy the sheets and make multiple options, right? So in this option, we were always hiring 100,000 square feet of space, always. But what if that's not the case? What if we go with the flexible lease option? So what, option 3. So let me copy this over. So I copied option 2. We can call this option 3. Okay, so here it's more complicated. Now, what we're saying is that first of all, we'll be paying $10,000 upfront. So we are paying the warehouse company a $10,000 retainer, irrespective of what our demand or spot market price, anything, we're just paying them $10,000 upfront. So the first change that I will make is that net present value is not just this, but also we are going to subtract $10,000. We are going to subtract $10,000 because we are paying them $10,000 upfront. So that's an extra fee that we are paying them for this extra flexibility that we have. So I'm going to keep that. So that goes in there. The numbers have to change. So this is not the final answer yet. So we are subtracting the extra 10,000. We're paying them $10,000 upfront. And we're saying that if our demand is anywhere between 60,000 and 100,000, then we will pay exactly how much we need. So for example, when demand is 80,000, in the fixed lease case, you still had to rent 100,000 units of space. You still had to pay $100,000. But in this case, you're saying that if demand is 80,000, I'm only going to rent 80,000 units of space and only pay for 80,000 units of space. If demand is 64, I'm only going to rent 64,000 units of space and pay only pay $64,000 in cost. That is the flexibility that you're demanding, and for that flexibility, you're paying an extra $10,000 upfront. So the question is this a viable option? or is this better than the previous option? Because option 1 is obviously the worst. I mean, the net present value is so low. It's basically 5,400, right? So option 1 is not a consideration. It's just between option 2 and 3. So this extra 10,000, does that balance things out? Let's see what happens. So contract space. So this is where we have to carefully keep track of contract space and spot market space. So here I'm going to make some changes to both of these formulas. So I'm going to say that contract space, it was always 100,000. So we're going to have to write a formula here. So if this number is between 100,000 and 60,000, it is going to be that number. So I'm going to say that if this number is less than 100,000, sorry, is less than 60,000. If the demand is less than 60,000, then we want it to be 60,000, because you have to rent a minimum of 60,000 units of space. You cannot rent less than 60,000 units of space. But if demand is more than 60,000, then you want the demand to be that number, but only if it is less than 100,000. So if it's more than 100,000, again, we are done. So you say that, so if demand is less than 60,000, then the contracts, you have to rent at least 60,000 units of space. But if demand is more than 60,000, so again, we'll write another if function. So if the same demand is more, actually, I mean, we are doing less than, so let's say it's less than 100,000. So don't worry about the equal to. The equal to will balance out. So if demand is 60,000, is less than 60,000, we keep it 60,000. If not, so this is a scenario where demand is not less than 60,000. If demand is less than 100,000, then we want it to be the same number. So we want it to be A3. We want it to be A3. If not, we want it to be 100,000. Now this is a complicated formula. There are two if statements nestled within each other, but you don't have to do this. Now I like writing complex formulas, so I'm going to do that. So let me see if this worked out for me. Yeah, it did work out for me. It worked out for me, but you don't have to do this. I mean, there are only so many numbers. You can literally just say, okay, demand is 100,000. I'll need 100,000 units. Just type in 100,000 here. 100,000, 100,000, because demand is more than 100,000. Because demand is 80, you just need 80. So you don't have to write this complex formula here. But I like writing formulas, so I'm going to write the formula there. Now, as far as the spot market space is concerned, yeah, it's the same. So we're saying that if the demand is less than the spot market, is less than the contract space, so in this case, it should just be less than 100,000. Right. You're saying that if demand is less than 100,000, then you don't want any space on the spot market. But if demand is more than 100,000, you want the difference to be on the spot market. Let me make that change. But I mean, even the previous formula would have worked. It's no reason to change the formula, but just to be consistent. There you go. So when we have a demand of 120,000, you'll get 100,000 units of contract space, 20,000 units of spot market space. When demand is 80,000, you'll just get 80,000 units of contract space. So the cost should have gone down, right? And the net present value of the profit should have gone up. So the net present value of profit is $46,545 as opposed to $38,363. Remember, this is $46,545 after subtracting the extra 10,000. So you're paying them 10,000 upfront. In spite of that, you're making $46,545. And the reason for that is, you'll notice that with option 2, there is a small possibility that you'll make a loss. And the reason for that is you're always paying $100,000. You're always renting $100,000. So there is a small possibility of making a loss, right? But not with option 3. With option 3, with the flexible lease option, there are no possibilities for making losses. So it's still contract spaces at $1, the non-contract spaces at whatever the spot market price is, and the revenue is the same. You're just multiplying the demand times $1.22, and then of course the difference. So in this case, you'll never make a loss in whatever possibility. The least profit that you'll make is 14,000. The highest profit that you can make in any scenario is about for that particular time period will be about 24,000. But you will never make a loss, and the net present value of profit is 46,545. And obviously, we should go with the flexible lease option, right? There you go. Now, this is always tedious. Like I said, this will take some time for you to set up the first set of these numbers and the first set of NPV calculations. But after that, everything is simple. In fact, because most of the time we will be doing binary calculations. Even this, I mean, if you retain this particular, I will post this Excel sheet on Canvas. If you retain this Excel sheet, many of the things will remain the same. The way you calculate cost and the way you calculate revenue will change, but the profit calculation and the net present value calculation, they all remain the same, because the trees will look the same based upon binomial calculation. The other difference that might be is that when we wrote these, we wrote the probabilities as 0.25, 0.25, 0.25, and 0.25. Those probabilities will definitely change. That's the other thing to keep track of. Otherwise, that's most of the things are set up in the exact same way. So I'm going to save this. Strips, logistics. Decision tree, and I'll post this on Canvas. All right. Okay. I am sorry. I mean, this is a longish video. I wanted to spend some time on it to make sure that you understand it. Now, you can notice you can compare my calculation with the calculation in the textbook. It'll all be the same, but I didn't go over all of this. So next week, what we'll do is we are going to we did the TRIPS logistic. Next week we'll be looking at offshoring versus onshoring. So if you have the option of offshoring something, what is the cost of offshoring? Just the relocation cost. We're not looking at all the other costs that are involved with offshoring, but just that. And even that you can do with decision trees. We'll talk about that next week. For the time being, thank you, and best of luck.